Ladies and gentlemen, welcome back to the channel. Just when you thought this market was getting ready to explode to the upside. I mean, look at that chart. Looks beautiful. Beautiful. Moody's downgraded U.S. credit in after hours yesterday. I want to share with you some of the historicals around this. This has happened before, and what this could do to markets. Surprisingly, I'm not super concerned, even though the S&P did fall 1% pretty abruptly after this downgrade. It's not as bad as you would think, although it is kind of bad. So we're going to get into that here in this video. Let's start with this downgrade situation. So Moody's downgrades United States credit rating, citing growth in government debt. Moody's had been a holdout in keeping U.S. sovereign debt at the highest credit rating possible and brings the 116-year-old agency into line with its rivals. So other credit rating agencies have already downgraded U.S. debt, some of which did so a long time ago. Now, let me explain how this works, okay? This goes for any investment ever. I can tell you how risky it is if you tell me what it yields, okay? If you have a 10% yielding dividend stock, I don't have to know anything about that company unless you're in a severe market crash. It's risky, okay? Because why do you have to pay 10% to entice capital, okay? Yield is a reflection of risk in anything. If somebody calls you up and says, hey, we're going to double our money in a month off of so-and-so, you're probably not going to. It's probably really risky. If, you have a business venture that you're going in and it says you're going to make 25% in a year or something, you're probably not. If you do, you're going to take on a lot of risk, okay? Somewhere in some shape or form, okay? Yield is yield is essentially a derivative of the risk profile of the asset. So what Moody's is saying is the United States is riskier now than it was yesterday, which is obviously not true, but they're assigning this downgrade, okay? So what that means is the yield on government debt should be higher to compensate for that. Now, here's the deal. 10-year treasury yields only went up about 3 basis points on this because everyone else has already downgraded U.S. credit, okay? It's already happened. Moody's was just the last one to do so. So that's why I don't think it's a huge deal, but it's kind of like, damn, that's it. Everyone has downgraded U.S. debt at this point, okay? It says, quote, this one-notch downgrade on our 21-notch rating scale reflects the increase over more than a decade in government debt and interest payment ratios to levels that are significantly higher than similarly rated sovereigns, the rating agency said in a statement. So basically, if you look at apples to apples, our apples don't look as good as other apples, okay, in terms of governments, which is, again, fair. The decision to lower the United States credit profile would be expected at the margin to lift the yield that investors demand in order to buy U.S. Treasury debt to reflect more risk, and could dampen sentiment towards owning U.S. assets, including stocks. That said, all the major credit rating agencies continue to give the United States their second highest available rating. Again, I don't think this has much of an implication at all to stocks, but there is that correlation again between bonds and stocks. The higher bond yields go, the more money that should entice into bonds as a risk-free, we'll see, risk-free return. And that takes away from buying pressure in stocks. That's the relationship, but I don't think this credit downgrade really has any affiliation to stocks whatsoever. It's the government. You don't invest in the government. 99,999 times out of 10,000 in certain stocks, right? Some stocks do business with the government, but again, that it just doesn't mean anything, okay? It says Moody's has been holding out and keeping U.S. sovereign debt at the highest credit rating possible and brings the 116-year-old agency into line with its rivals. Standard & Poor's downgraded the U.S. from AA+, or from AAA to AA+ in August of 2011. Again, this happened like a long time ago, okay? Which the markets did actually respond a lot when that first downgrade happened. In fact, it's kind of funny. The guy that downgraded credit was fired because of the market reaction, because of the just, whoa, like that was, it kind of came out of nowhere at the time. The guy that made the decision was ultimately fired. And then you didn't have a credit downgrade for 12 years. Fitch Ratings cut the U.S. rating from AAA to AA+ in August of 2023. And markets didn't respond at all on that. Like there was like no response at all. I don't even know if most of you guys remember that in August of 2023. So again, Moody's is kind of seen as like one, the bigger rating agency, Fitch, kind of the smallest. Again, I'm surprised we actually fell 1% in after hours on Friday, because I don't think it's a huge deal. Quote, successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. Moody's analyst said in a statement, quote, we do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. So they're basically saying Trump's not going to help the deficit, okay? And then last thing we're going to read here is, quote, less demand. Treasuries are still dealing with the fundamental factor of less foreign demand for them, and the growing size of the pile of debt that needs to be constantly refinanced is not going to change. But Moody's is symbolic in the sense that here's a major rating agency that's calling out the U.S. has strained debts and deficits, said Peter Brockver, chief investment officer at Bleakley Financial Group. So again, it's a big firm. But again, I think this was largely already priced in, at least in the bond market. Like, look at bonds. Bond yields are almost 4.5%. Someone probably already knew this downgrade was coming a long time ago. That's why bond yields have not been falling. I kind of personally thought it was weird that we signed a trade deal with China and recession risks, went down, inflation risks materially fell, and bond yields really didn't react to that. Probably because this downgrade was well on its way at that time. So just kind of bottom line in a nutshell so we can move on. This is not great. It's not good news. But I don't think it's new news. I don't think it's something that Wall Street's going to care about over the next couple of days. You got a 1% knee-jerk drop on the S&P, a lot larger of a drop on other stocks. But again, I don't think this is something that kills the bull market because it was largely expected. Okay? And nothing actually changed. We still have the same backdrop as we did before, besides just the rating went down one notch. And, honestly, like, this has nothing to do with my 20% upside investment thesis from this point. Like, downgrade or not, who cares? I think the fundamentals are intact for this market. That is, labor market is strong. Inflation is going to continue to come down. The Fed will be able to cut rates as inflation comes down more than expected. AI, obviously, going to continue to progress, especially as rates do come down, hopefully here over the next 6 months or so. Deregulation, lower taxes. that is why I think a 20% rally is coming in markets from here. Again, that's putting you in the neighborhood of 700 on the SPY by the end of this year. Moody downgrading U.S. credit does not change that at all. Percent of stocks trading above their 50-day moving average is at 71.4%. You are on the higher side of rallies. Okay, you can go higher. You can get into the 80s, like 85% is a very healthy level. You were kind of there in February of 2021. You were there briefly in August of 2022, January of 2023. You were there as well in December of 2023. You haven't been this high, though, in fact, since then. Since December of 2023, you haven't seen this many stocks above their 50-day moving average. That is because the correlation in markets is incredible these days. I mean, look at even Friday. Like, stocks just went up. Like, on a green days, like 80% of stocks are green. Okay, that's really good breadth. You can see here the breadth on this market is like something we have not seen in a long time. It says October of 2024, but I mean, I can't recall market breadth this correlated for a long time. But it is in extreme greed. Put and call options is greed. Market volatility is neutral. Safe haven demand in extreme greed, and junk bond demand in extreme greed. Stock price strength is greed, and market momentum is still in extreme fear. I don't really know how. I feel like that should maybe be in fear or neutral at this point, but that does give us a headline number of 71. So the point I'm trying to make here is we were due for a little bit of a slowdown regardless before blasting through new all-time highs. Okay. And what that catalyst is that gets us there, if it's economic data, if it is, another trade deal. Trump says a deal is coming soon with India, but he's not worried about the timeline. I mean, I don't know what the catalyst is that's going to get us to new all-time highs at this point, including the move down in after hours on Friday. You're only 4% away from a new all-time high. I think that is coming, but again, this Moody's downgrade could be a little bit of a speed bump that we were otherwise going to get regardless. But I don't think it is, oh my gosh, this downgrade is, no, it's not nearly as bad as what you're going to hear from some on Wall Street and some bears. It's not the big bad boogeyman catalyst. Sorry, it's not. I think you still want to be firmly bullish on equities if you were before. Like, this doesn't change my thesis, not even in the slightest bit. Doesn't make me more bullish, let's just say that, but it doesn't change my thesis at all over the next 6 months, which is for a 20% rally in the S&P, which, again, if you're looking at the spectrum of like what people expect, that is way on the bullish side. So if I'm correct here and the S&P is, 700 by the end of this year, we should have like 5 million subscribers on this channel, because nobody's projecting that. And I think Wall Street's going to come around to the idea of owning more stocks over the next couple of months. Because let's face it, Wall Street is super underpositioned in this market. And, that's probably not a good thing to be, is underpositioned when you have all of these positive things going on. And China trade deal, which is really the main catalyst that set all of this off.